Good morning and good afternoon, everyone. It is August 20th, Thursday. Welcome to Morgan Stanley Asia Macro Webcast. My name is Crystal G, Asian EM Market Strategist. Before we start today, please note that this event is for Morgan Stanley institutional clients and financial advisors solely. It is not for member of the press. If you are a member of the press, please log off and reach out separately. Please also note that this session your purchase may be recorded. Today we have Chetan Iyer, Chief Asia Economist, Jonathan Garner, Chief Asia Emerging Markets Strategist, Daniel Blake, Head of Asia Thematic Strategy and Asia EM Equity Strategist, Kathleen Oh, Chief Korea and Taiwan Economist, Jun Sok, South Korea Equity Strategist, and Head of Korea Financial Research.
Thanks, Crystal. So from the macro perspective, I think when we're talking about capex super cycle, which I have discussed on this forum several times, we always get this question about how is Asia going to fund this capex. And so what we've done in this note is to try and understand how is it that Asia is positioned from macro perspective on funding, and then what are the sources that Asia is using for its capex plan. So let's first look at the macro story. So when we are looking at funding story from a macro perspective, we always look at the current account balances. And in Asia, most of the economies are in current account surpluses, which is about 8 out of 12 economies. And generally, when you have current account surpluses, it means that you are running your saving higher than your investment, and therefore they can fund their capex domestically. They don't need to necessarily rely on foreign funding. On the right-hand side chart, you can see that even the ones which are running current account deficits, especially the EMs which is India and Indonesia, are not really running very high level of current account deficit. So as such, we don't think that a macro level funding is a problem or a constraint for the region. But we do have an interesting story in terms of the funding mix in Asia versus US particularly. So at a macro level, when we look at the funding mix in Asia, it is far more dependent on loans compared to, so if you look at the bold black lines at the bottom of this table, that's the very last line is giving you the Asia number, and the very first line is about the US, so simple to compare that way. So as you can see, loans in Asia are 72% of total, whereas in the US, it's only 18%. And the bigger source of funding for the US is debt markets, credit markets, which is reflected in the debt securities in this table, and also reflected in the very last column, which is titled Other Liabilities. But private equity is the big chunk of this other liability. So private credit and public credit has been the biggest source for the US in terms of macro funding, outside of internal accruals, whereas in Asia, it is largely bank loans. And then the next category in Asia is debt securities. So that's as far as the overall countrywide or region-wide capex story is concerned. I also wanted to share one other fact in terms of the AI capex funding. And when you look at the AI capex funding, Asia is going to see a big rise in capex, of course, not as strong as the US, but nevertheless, by Asian standards, it's going to be rising quite rapidly. So we expect hyperscalers capex in Asia to rise from $80 billion last year to $250 billion in next year. And when we think about the funding mix for this capex, in Asia, it is, again, largely loans, as we had indicated earlier, as far as outside of internal cash funding is concerned. But the internal cash accruals is the bulk of it, and in this year, as well as next year. Next year, there will be some increased reliance on bonds, which is the convertible bonds, which is what hyperscalers in China have been doing. But nevertheless, it's still going to be 80% funded through internal cash. And whereas in case of the US, it's going to be largely credit. So as you can see, the mix here, the percentage numbers that you see is basically percent of total funding that is required for hyperscalers data center capex. Equity, i.e. internal accruals and equity issuances will be 45%, but credit markets are larger at 55%. So that's the mix. You can see the breakdown there further, but I think in the sort of interest of time, I will just stop here as far as the AI capex story is concerned. Just one final point on the macro funding as well as AI capex funding is why one of the questions that fixed income investors ask is why not corporate credit and especially dollar credit like it's happening with the US hyperscalers. And the answer to that is on this chart here on the left-hand side, which is that Asian interest rates are lower than US interest rates. And also that until yesterday, we have been seeing that the Asian currencies are depreciating. So if you are a company in Asia, you would not prefer to take dollar loans or dollar credit. You would just prefer to take bank loans domestically. Which has been a very big source for Asian corporate sector. So with that, let me stop here and hand it over back to you, Crystal.
Thanks so much, Chetan. And then we'll leave the Q&A to the later section before other comments. And then recently, another center of the debate is around the long-term yields. And then yesterday, we were also doing a lot of meetings with clients. So Jonathan, can you share your views on the impacts and implications on the Asian EM equities?
Yes, thank you very much. And just before I get into the long-term yield move and how we would think about it, I do just want to emphasize how extraordinarily strong the earnings growth environment is right now. For Japan and EM. Earnings are actually tracking now close to the bull cases that we put into play in mid-May, so tracking higher than our base cases with very positive revisions. I guess the difference is that in Japan, they're more broadly based, and in EM, this issue that has been common throughout the year of the sector skew towards semis and tech and the market skew to Korea and Taiwan, that remains the case. We're not seeing a more generalized upward revision estimate story across EM. What's happened is that the valuations have moved lower. For example, on a 12-month forward basis, EM is trading over 10 times forward right now, which is actually below the long-run average. And I think that's happened in the S&P as well. And it is related to the question you asked, Crystal, about yields, but it's actually real yields that matter for equity valuations, as equities are a claim on real assets, not nominal yields. And what was important yesterday, at least to my mind, was that the 10-year TIPS yields fell 10 basis points after the announcement that the US Treasury was going to implement an enhanced buyback program for longer duration paper. So from that perspective, lower real yields should actually help valuations not just stabilize, but perhaps move higher, which would be good news, generally speaking. The more obvious issue that lower real yields can sort of raise is again, other real assets, and in particular ones that don't have a yield, like commodities, and in particular gold. So it's no surprise that gold was up about 4% overnight our time and has held most of that strength this morning in Asia. We happen to add back some gold exposure to our focus lists about 48 hours ago, so do check out the research portal for how we did that and how our colleagues are approaching this. But in general, we're constructive on markets. June is on the call later to talk about Korea, so I won't say too much about that, but I'm certainly very encouraged by the buyback news from the large stocks in Korea and the way in which volatility is actually gradually declining over time. So We remain with our overweight Korea recommendation that was put in place on the 2nd of August. Thank you very much, Crystal.
Thanks, Jonathan. And then today we also have Daniel, and who just came out with this piece on global thematic tagging. So can you share with investors how to utilize the framework and also derive the alpha signals? And also, can you also highlight the important screenings in this report as well?
Okay, thank you, Crystal. Yeah, we are very proud to launch this global department initiative. We call it the thematic map, and what we've done here is move the entire coverage, more than 3,800 companies, into tagging across materiality of their AI exposure. 16 sub-themes. We add a disruption deflationary layer. We add AI challenge materiality. So really this is a huge department exercise. We also move this into real-time status. And so now we've got this point in time materiality. So as we're thinking about the distribution of key themes, the impact of thematic investing, one of the challenges that we've often found is we put out a 100-page report, maybe a 200-page report, blue paper on topic X or Y, looking at humanoid robots or autonomous driving. And how do we scale that into investor portfolios? How do we keep track? How do we come back and revisit companies that have added exposure, or companies maybe that have exited a theme or their trends, companies that have increased in materiality? And so this dynamic mapping, we think, can really be a structured way for clients to access thematic investing and then connect that directly to portfolio construction. It's a nice complement for the other structured research data initiative, which we call alpha signals. And alpha signals are structured catalyst previews, previews to earnings, reactions to earnings. And what we're finding there is a high Sharpe ratio of analysts going into the earnings season with a clear KPI, set of KPI expectations, and recommendation for where that result is going to take consensus. So these two are highly complementary. We've got the long-term themes translated into stock exposures, and we've got the alpha signals, which can then translate key events and updates around the short-term trading of that longer-term theme. So as we're thinking about the mapping, we've got this incredible data set, which we do make available for clients. Please email me or email Crystal for a copy of the latest mapping. We again will have this dynamically updated, so we'll always send you the latest update. In terms of the exposure trends, we can run through some really interesting alpha opportunities. And so what I'll do is I'll quickly touch on the structure, second on the alpha opportunities, and then third, a live example in the wild, as we published, just this morning and just overnight on AI sovereignty and semi-localization, which is a key thematic and a growing thematic. So where do we sit? We can then look at the distribution of coverage across the region's relative strengths, as we show in this. But for the mapping itself, we've streamlined this into a 4x4 structure with this disrupted layer sitting underneath it. So 4 in AI, 4 in future of energy, 4 in societal shifts, and 4 in multipolar world. When we're thinking about the disrupted layer, the innovation that we have here now is that instead of a company needing to be either an adopter or AI challenged, like disrupted, we can now assess the degree of adoption and the degree of AI challenge status, and again revisit that through time as we're seeing industry structures emerge, as we're seeing business models change. This is going to see dynamic shifts, and historically we've seen already alpha being generated both in the exposure and the rate of change in AI, dating back to 2023. So out of sample surveys showing consistent alpha generation on both fronts. Now we can run that right across the 4 core themes and 16 global sub-themes. So super excited about having that up and running, and that can let us understand the structure of the market, the key drivers of the market, and one of the obvious examples we often get is to which degree a market's exposed to which theme, and what we've done here. Let me zoom out of this one. Is look, for example, at the key markets in APAC. And we've broken out AI upstream from adopters. We show the future of energy shifts and societal shifts, multipolar world. Again, we can go down to the sub-theme, but we can see here that Japan, Taiwan, Korea are still showing the most thematic exposure. but we have a lot of multipolar world exposure sitting in China, 18% of the index having core exposure to this theme. And when we look back at the preferences we've had as a collective strategy team with Laura Wang and Jonathan, we can see that actually a lot of the preference we've had is sitting in AI upstream, semi-localization, multipolar world, and we think this can really help separate the alpha from what can sometimes be a challenging beta environment. So for the alpha opportunities, again, we really, I think, are just scratching the surface of this data set. So we start with the obvious questions. What about stocks that have got multi-thematic exposure? We can weight, given the materiality, given the 16 themes, we can weight then the sum of, say, core and significant and moderate exposure. And at the top here, we see SpaceX, but we see a number of interesting companies and many in APAC that have got exposure to multiple themes with core or significant levels. And the performance, I think, no surprise to see that we're seeing them outperform 152 percentage points from versus MSCI ACWI since 2023. With a pullback in July, as we saw, the second largest momentum unwind in history, but we think that's a correction to be bought. And secondly, we can look at the disruption. With AI challenge, we can look at the depth of AI challenges across markets. There are some interesting conclusions that we can unpack. But as we look at that, we can overlay and find the most thematically challenged companies. And so we can combine areas where another sub-theme, maybe it's the diabetes ecosystem is driving disruption, overlay that with AI challenge status, and that cumulative effect can really be a challenge not just for earnings, but clearly valuations. So in Exhibit 11, we showed the most thematically challenged companies. Again, we have the full list of 3,800 on this ranking. And again, no surprise to see the underperformance of the thematically challenged, underperforming ACWI by 38 percentage points in the last 12 months. Another interesting theme, which Crystal, I know you led the work on this, looking at the long-short performance within themes. And so as we broaden out and catch more and more disrupted deflationary exposures in these sub-themes, we can look at long-short pairs and look long-short pairs within economic security, within humanoids, within aging society. And what we've found here is that every one of these long-short pairs has delivered alpha, again with average alpha of 22.8 percentage points in the last 12 months. And we expect that to continue being delivered going forward, as we've seen so much out of sample alpha in the AI mapping surveys dating back to 2023. So finally, just rotation, this debate around a broadening market. We can also use the data sets to identify themes in the way we would look at a stock or look at a sector. And we can see here that we no longer have such a relative strength of AI and tech diffusion revisions, earnings revisions breadth here. We're starting to see even societal shifts themes deliver net upgrades. To Jonathan's point on the strength of earnings, this is really quite broad-based across themes. And as we're looking at the comps for each of these across growth, valuations, revisions, we can see that there is an opportunity to start to broaden out into other sub-themes. So we think this market broadening is a broadening across themes, not a broadening into disrupted or non-thematic stocks. And so ultimately, we still think this is going to be a case of looking for key adopters going forward, using the mapping to help filter, to help generate the right exposures. But also seeing this pullback in momentum in July, having given us a better entry point to what was a very crowded exposure to areas like the AI enablers. So for us, it's a great data set. You'll expect to see much more utilization of this, but please do reach out. And just to conclude with one example in the wild, as it were. So I mentioned long reports where we want to translate that into portfolio construction and filtering and ideas. This morning we published alongside Ariana Salvatore's leadership on the topic of AI sovereignty. And so, as you saw, that was one of the key themes that we include in the global mapping. We can see this concept is reinforcing the investment, the upstream investments, as we see US-China competition, but also a need for other countries, rest of the world, global south, to be able to serve models, whether they're coming out of the US tech stack or they're an open weight structure that they want to be using for their own delivery of intelligence across critical infrastructure. And good examples being the work that Singtel is doing through its own cloud business for key infrastructure and government clients. And so as we're looking at this, we can also use, again, that global mapping, 3,800 stocks to exposure to AI sovereignty. And as we look at the distribution here, we can see that this is not just a case of semis. We've got 11% of the significant and core to thesis and moderate stocks sitting in capital goods. We've got telecoms, 13% weights, even autos. So it forces us to think, why are we seeing that trend? And we're seeing that trend because when we're thinking about AI sovereignty, autonomous driving, the roadmap here, we're seeing companies actually putting capital to work to ensure that they've got their own training data sets, that they can use that for their own national security as we're looking at the deployment into embodied AI. So the outcome then gives us, again, a chance to look at where we sit in the theme, and AI sovereignty as relatively high growth, relatively full valuations, and not out of line with the growth expectations, earnings revisions that are still moving to the upside, and then beneficiary lists that we show the top 50 here globally, but again, reach out for the data set, filter through, and use this as a point of exploration for further stocks to unpack. And I did mention Singtel, but names like a Gulf Development, Advance, and Reliance, all sitting with this key exposure to the theme. So with that, I'll pass back to you, Crystal.
Thanks so much, Daniel. And again, if you need the underlying data set or the report or any of the screenings, please do let the whole Global Thematic team know, and then we will send it over. And then last but not least, we have Kathy and June today to walk through their team's view on more constructive view on creator economy. And then June also sees further run for KOSPI. So maybe let me turn over to Kathy first, and then lastly to June.
Sure. Good morning, everyone. Thank you, Crystal. So we have published a thematic piece on Korea looking into the economic implications of what this AI supercycle story would imply. And today I want to discuss what we think could become one of the most important macro stories for the economy for the next 3 to 5 years. We think Korea is facing an extraordinary semiconductor windfall, and that the second order transmission to the broader economy could put a meaningful upside potential to the growth outlook in the next 3 to 5 years. Let me just share a report here. Right. So we think this, we think the market focus is largely currently sitting on the first order effects, the semiconductor exports, earnings numbers, and the share prices. But the second order effect is actually coming through from this end of this month, when the corporate tax income receipt will start to come through from Samsung and Hynix. And we want to flag to investors that this time, this cycle is quite different from what we've seen previously in the previous semiconductor upcycles or export upcycles in a couple aspects. And this actually could be quite a significant upside story again, starting from rest of this year onwards. And we want to flag that there could be a structural inflection point coming with this windfall benefiting multiple channels into the economy. So want to flag that this cycle is actually quite different from the previous cycle in 3 aspects. So first is actually we do see that the scale of the windfall is quite different. We're basing our numbers with our tech analyst Sean's earnings forecast for Samsung and Hynix. And just for this year alone, we're expecting 647 trillion of earnings combined, these two chip makers, and compared to 90.8 trillion we've seen last year, this is up more than 600%. And this is already showing in the macro data. We're seeing semiconductor exports surging 160% this year. We're seeing the real GDP growth jumping 3.75% in the first half of this year from 1.1 last year. And more importantly, GDI, which captures this terms of trade change, had jumped 14.4%. That's the highest in nearly 30, 40 years. So the point here is that this cycle is not simply about Korea producing more chips, but Korea receiving dramatically higher prices for those chips. And that could potentially feed through into higher national wealth, as well as the allocation to other sectors in the economy. Second is visibility. So we do have this time, it's not just about short-term cycle that we've seen previously with the memory exports. It's usually been shorter than 2 to 3 years, but this time we do have more visibility with these LTAs as far as next 5 to 10 years of the demand secured, and also the global AI infrastructure build and capex increase related to that could offer more confidence for these chip makers in terms of their feed through into the economy in terms of again investments and the more to the governance story in the near future. And third would be, of course, this time it's more about the income-led story rather than the cost-led. So historically, we've seen when the corporate earnings grow based on a lower cost, such as, for example, for Korea would be the lower oil prices, that usually led to corporates retaining their earnings rather than quickly translating it to investments or wage growth. But this time, because it is led by more income story, as we see in the export prices surging a lot more higher than the import prices, we can see that this will be translating much faster into the economy through the corporate decisions, especially this time would be the capex channel. So we do see 3 transmission channels into the broader economy from this windfall. So first is the tax channel. The fiscal capacity would benefit largely from these corporate income receipt from Samsung and Hynix. Just rough estimate for this year, we're seeing about 100 trillion of corporate tax income from Samsung and Hynix, and that's double the size of the entire corporate sector receipt we've had in 2025 in Korea, which was 85 trillion. And according to Sean's earnings outlook, it's not just going to be a one-off story, but we do think next 3 to 5 years of her huge earnings, the absolute size of the earnings growing, despite the rate of growth could slow down, that it could feed through largely into the income of the government. And we think this could add to 20 to 40 basis points to annual GDP growth. And this is a very conservative estimate at this point because we haven't seen the execution plan from the government, which we will get in the budget proposal that's coming out early September. So the amount of the surplus that we get and how much the allocation to government investments or to the strategic industry will be key here. So then that could add to even more upside to the growth contribution from this tax surplus from these 2 corporates. The second would be, of course, and even more larger effect would come from the capex channel. Samsung and Hynix have already announced their 3,000 trillion capex plan through 2040. And historically, we've seen their annual capex for the domestic economy had been around 55 trillion. So compared to that, we're looking at 167 trillion for the rest of this year, and then even towards 200 trillion or more in the next coming 3 to 5 years. So that could add 220, 150 basis point upside to the GDP growth And we think initially it would be related to more construction-heavy activities, and then later move to equipment-heavy investments that later on could raise Korea's productivity overall. The third channel would be of course, the household income channel through the wages, the compensation of the workers under these two firms. And we've had very specific numbers that, in a sense, that it's not hugely impactful in terms of the actual labor force and the wage growth overall, given that only 0.5% of the workers at Samsung and Hynix make up only 0.6% of the labor force. But we do think there is a possibility that the income effects could broaden into the supply chain overall, construction, power infrastructure, robotics, and these broadening of the semiconductor wage growth could then fit through to the more boosting of the wider domestic demand story, which we think could add on 25 to 45 basis point upside to the consumption growth in the next 3-5 years. Again, in our bull case, summing up, we see about 245 percentage point upside to Korea's trend growth that could bring the real growth in terms of GDP close to 4 to even 5% or higher. So in that sense, we do think there is a significant upside to our growth forecast for next year and beyond. We currently sit above consensus at 2.7% for next year versus consensus of 2.3%. And we have only partially reflected these upside potentials from these windfall. And we do think from next week's 2027 budget draft will be a key catalyst that we could actually see more tangible upside that could feed through to Korea's economic growth from 2027 onward. And we do think we are just starting to see these windfall passing through to the economy, and this could be potentially a structural longer-term story if these windfalls are allocated to the strategic investments in particular to boost the productivity and potentially ultimately to the potential growth rebound story for Korea. I'll stop here and pass to you. Back to you, Crystal.
Thank you, Kathleen. And then last but not least, we have Jun with us to share his views on KOSPI after the rally following the buyback announcement. Over to you, Jun.
Yes, thank you, Crystal. So, we were quite confident that the capitulation that we saw in July would be kind of behind us in August. And now we're sitting at around, 6,800 as of now. And our target for this year, for June next year, is 9,000. So there is still a lot of upside here, but rather than a V-shaped recovery, we're looking for more of a gradual kind of recovery where we could see a bit more broadening out. We'll probably have to start with the chip makers again in Korea because yesterday there was a key announcement, and our kind of view on this, the capital management, which is I think very much linked to the LTA story, because the LTA itself is positive in the sense that what you're going to get in terms of earnings and cash flow, but that needs to be provided to the shareholders in order to be positive. So yesterday was a first step forward as one of the chip makers announced the buyback of 40 trillion won, which today you were seeing a good move up for the chip makers, up around 10%. And what was I think noteworthy that is that there was a message that there could be more upside going forward. So we're kind of hoping that the chip makers here, if they're paying out around 50% of the free cash flow or above that, that would be quite positive. But we are also seeing numbers for for companies outside of Korea actually being higher. So the expectations have been met here, but we need to also just look at, I think, some of the affiliates out there, which is also an interesting story. So if you look at like Samsung Group itself, Samsung Life, Samsung C&T, Samsung Fire and Marine all have ownership there, and they're all linked to the capital management story. So it is, I think, a broader story than just looking at the chip makers. And if you look at our kind of view on the corporate DNA reform, we are kind of seeing the policy side of it has actually played out quite well. and there is more coming. But our kind of view is that the ball is on the court of the corporate sector, and hopefully we do see a lot more proactive capital management from here. And last year for KOSPI, we had, I think, 17 trillion won of buybacks. And I think this year now is going to be, significantly higher than that. I think we're sitting at around, 6-7 trillion won right now. So that is going to be quite positive. But I think this is a good segue into policy. So we have been getting a lot of questions on the ruling party leadership change and, what kind of policy implications that has. So the new Democratic Party Korea's leader is Mr. Kim Min-seok, who was the prime minister under President Lee. And during his acceptance speech, he talked a lot about kind of focus more on the economic and the financial kind of market agenda. And he also talked about ABC, and ABC kind of stands for A is affordability, is try to help out the, to reduce the burden of living costs for the households. B is for broad, where he wants to broaden the appeal of the party. Again, this would be probably linked to the economic and capital market reforms. And C is for competence, where, he's talking about policy execution that needs to be done well, and there needs to be meaningful kind of impact on the household. So I think all this kind of points to that the government is going to be more focused on the economic side and also capital markets. And in terms of the corporate governance drive, that is gaining a lot more traction right now. And we've seen a lot more news coming out where the dual listing rules were changed and actually implemented already as of August 3rd. We're seeing news about the Anti-Stock Price Suppression Act, revisions to the Capital Markets Act, the Stewardship Code. So there's a lot of, there's a lot on the plate right now. And our kind of view is that, this should largely be done within the second half of this year. But it's not just about that. It's also about some of the commercial code rules that had like a 1-year grace period kicking in. And that is mainly the cumulative voting. So we do see that a lot more. I think focus will be on the reform agenda. The second question we get a lot on is on the retail investors and how they're right now behaving at this point. We believe that retail investors may take some time for them to regain their confidence in the market. And I think some of the telltale signs here is that if you look at July, more than $4 billion of funds have actually gone back into the U.S. equities. August, I think we're also seeing that outflows, maybe not as large. So we are seeing, I think, let's kind of look back at the market that we were doing well in. And in terms of the brokerage account balance, it's below the 100 trillion mark. I think now it's around there. Margin lending has come down from the peaks and it hasn't really improved that much at this juncture either. And it's the same with the single stock leverage ETFs. We've seen a small increase in the AUM, but compared to the peak of 14 trillion, we're a lot below that. So on the retail investors, we believe that there needs to be a sustained upside where instead of like a strong V-shaped recovery, you do see a broader recovery, and the chip makers also show a lot more, I think, a lot more confidence. And I think capital management is also going to be quite positive there because, retail investors at the end of the day can get tax breaks because of the new dividend regime. And just to end my kind of presentation here, broadening out was something that we've been talking about. And if you look in the past 2 weeks, the performance of the market, sector-wise, we have seen a bit of broadening out where energy, materials, even like healthcare has done quite well. So, and if you look at the second quarter earnings, we are seeing that there's a lot more, I think, guidance is being positive for the non-IT sectors, including like energy, consumers, even financials. And actually, the IT sector had the weakest kind of guidance in a way. So we think that, defense, healthcare, consumer financials, again, are areas where I think there is more upside. And hence, it's going to be more of a broadening out than what we saw in the first half of the year. So I'll stop here.
Thanks so much, Jun. And then now we are moving on to the Q&A session. And again, if you want to raise any questions, please use the Ask a Question text box. So the first question is for Jun, following your remarks on Korean equities. So according to our conversation, these 2 weeks after our upgrade, what type of investor that you see the most interest to put more money into Korea? And then if retail investors are not coming back anytime sooner, then how do you see the views on KOSPI from here?
Right. So our kind of view of the second half was that the swing factor is going to be with the foreign investors, and we are actually seeing better flows here. Now, in terms of foreign investors, I think we are doing I think more calls with really a range of investors. But if you look at the hedge funds, for example, and we've shown this in our recent report, is that the degrossing has really been mostly done here. So I think the foreign investors are still looking at Korea, and within emerging markets, again, the broadening out story. There's really strong stories in areas of like defense. Areas of like energy transition and all that. So I think the foreign flows is where it's important. But even on the local side, there seems to be money to be deployed from some of the non-national pension funds. There's also asset managers that seem to have some money to deploy. So it's more of an institutional market at this juncture. And when we do look at the trading recently, KOSPI has gone up a bit. And that was probably because of the switch, where retailers are generally are a lot more focused on that market than compared to the foreigners. So, but for KOSPI, again, it is, I think, going to be more of a market driven by foreign flows, and we are kind of seeing that picking up.
Thanks so much, Jun. And then the next few questions are more for Jonathan. So according to your meetings as well, where is the client interest right now, and then whether people are looking to rotate, and then and then also what's your sector and the market view from here, and then whether you think that people should rotate into other sectors. And then another question is that how do you volatility from here?
Okay, gosh, that's a lot of questions. So our views haven't changed, but as Jun just said, when we're talking about broadening out, we're talking about broadening out within the sectors and themes that we already like, and certainly we continue broadly to prefer capex to consumer goods versus services. So as I mentioned in my remarks, we have been recommending adding recently to materials, and specifically copper and gold. We continue to like semis, memory, tech, hardware, industrials, capital goods. We also, a couple of weeks ago, added to upstream energy. So in that sense, we've broadened out. But we remain negative on traditional auto, OEM, consumer IT services, including e-commerce names, unless they have a growing cloud business, and all downstream industries affected by higher input prices. And we have gone more selective on financials, really just limiting our exposure to the markets where we're overweight. So, for example, Japan, Korea, and Singapore. So in that sense, it's a broadening out, but it's most definitely not a sector rotation strategy. And I think that resonates with clients. Obviously, client views are very heterogeneous right now. There is no strong consensus, and we see that in the divergent performance that different client types had in July in particular. And so I'll leave it at that. Thank you.
Thanks very much, Jonathan. And then now we are on the 45 minutes mark, and then we'll conclude the webcast here and answer remaining questions offline. Thanks so much for joining us, and do reach out to me and the team if you have any other questions. Have a nice day ahead.